Margin trading allows an investor to use borrowed money from TD Direct Investing in order to trade stocks and ETFs, much in the same way that a home buyer may use borrowed money from a bank in order to buy a house. In this webinar, we're joined by Bryan Rogers, Client Education Instructor from TD Direct Investing. After defining margin, Bryan will take us through the most common questions about margin, such as, why would I use margin? What are the advantages and disadvantages of margin trading? We also run through some examples of margin trading and provide a quick demo in WebBroker about how to read margin data in your TD Direct Investing account. And without further ado, I welcome my guest, Bryan Rogers. Bryan, how are you?
I'm great, Ryan. I'm really excited to be here.
Well, we're really excited to have you here and talking about margin. So let's start with the biggest question. What is margin?
All right. Yeah, that's a great question, Ryan, and I'm here to demystify that a little bit. Though, so the idea of margin, a lot of people, as soon as they hear that word, they kind of cringe and they think, "Oh man, that sounds really scary. That sounds like something only the big hedge funds would do or the professionals." And we're here to teach everyone what it is and also kind of hopefully demystify some of the mystery around what margin is. So think of margin as being a form of debt. So we all know there's unsecured debt like a credit card or certain loans that have no collateral, right? It's just based on the loan itself. Margin is very similar to a secured loan, like a mortgage or a home equity line of credit, something that has collateral, like a car even, where the bank knows or the lender knows that they have something they can sell or liquidate to get the money back that they're loaning. In this case, with margin, you're looking at a situation where you're going to use your securities or your investments as collateral, so you can even buy additional investments or even potentially take a loan based on your portfolio.
That's a good introduction. So, why would I even use margin, Bryan?
Well, that's a good question too. So it's something you don't have to use. A lot of times with a margin account, it's always in what we would call a taxable account or similar to what we call a cash account, something that normally you'd have to pay for all of your securities up front. So if you're going to buy, ABC stock or XYZ stock, you have to pay for that up front using your own money. Once you've used all of your cash, then you're at that point, you're out of luck. If there was an opportunity that came up to take advantage of a potential bull market or a potential opportunity on a stock that you think is going to go up significantly, you may not be able to purchase that because you want to hold on to your existing investments or something of that nature. But with margin, you can take advantage of that opportunity. Take a loan from the brokerage, so the broker company is going to give you money to buy that opportunity or that new investment as long as you have some assets that they can use as collateral.
That's interesting. Can you tell me a little bit more about any other risk variables?
Yeah, there definitely is risk involved with margin. That's something we do want to clarify today too is, whenever you're using borrowed money to invest, remember the same risk of making money is also on the opposite side. You have a much higher risk of losing that money as well. So losing the value of those investments, but that debt doesn't go away, right? That actual money you borrowed is still something you have to pay back. So the value you're using to borrow that money, is something that can fluctuate up and down. There's other risks involved as well in terms of the type of security. If it's a very volatile stock or something that has a really low value, if it's a low priced stock. And those are all variables that the brokerage firm looks at, not only the brokerage firm itself, but also the regulatory body. So in Canada, it's called IROC. In the US, it's FINRA. I know those are acronyms. Sometimes don't ask me what they stand for. I always have to look it up as well, but we love our financial acronyms. But they set a minimum standard of how much you're able to use, which we'll talk about today as well, but how much you're able to borrow against your assets and how much of a down payment in a way you're making in order to create a loan. But it's something that's also at the broker's discretion as well. So they can make it a higher requirement if they think the risk is higher as well.
Okay, well, let's stick with that loan, the idea of a loan. As a self-directed investor using a margin account, how would I know if my stock required a greater down payment or a greater amount or margin requirement?
That's an excellent question too, Ryan. There's lots of things out there, on the internet that you can look at on a different risk level for volatility and things of that nature. But the brokerage firm is usually going to give you that. So I know in TD Direct Investing's case, they're going to give you a link to a PDF document that's updated very frequently to say that, these particular equities or investments that are marginable meaning that there's a value that they would loan against these particular positions, they'll say, oh, here's a list that shows maybe these are unique characteristics that are different than what the regulatory body has set. We also do have, if you take a look at this document we have up right now, you can see that there's usually kind of a standard setting for different types of investments. So for example, listed securities in Canada and the US, so listed on the TSX or listed on say a major exchange like the New York Stock Exchange, more normally they're going to have a 30% margin requirement. So that's like your down payment or your minimum equity you would have to maintain, meaning the inverse of that is a 70% loan value. And then as you can see down this list, you can see it may go a bit higher where we're now requiring 50% down, and that equates to a loan value of 50% for things such as leveraged ETFs and other risky stocks that are below a certain price, like $3 and so on. So you have this at your disposal, this document to look at. And then also there is a link we have as well within TD Direct Investing where you can see any equities that are much more volatile and would fall outside of these standards.
I think the point would really get hammered home if we saw an example. Are you able to maybe show us an example of buying a stock on margin?
Yeah, absolutely. I can take a look at an example. So if you take a look at the slide we have up right now, you can see that if we were to buy a stock using margin, I know most of us that are self-directed are looking at, how can we take advantage of opportunities in the stock market? So this is a really simple example, but it should hit home on how margin works. So if you look here where we see if you were approved for a margin account, so that's something you do have to do initially. You have to get an approval when you either open your account or you can call our investment center and they can oftentimes guide you how to add that on afterwards. But on that very first step, you see if I was approved for a margin account and I deposited $5,000, that we're looking at Canadian in this example, and I decide to buy ABC stock and it's currently trading at $25 a share. So if we're looking at a loan value, remember when we're talking about loan value, we're saying similar to a margin or a home equity line of credit, if you have a certain down payment of, for example, in this case, we're looking at stocks would be 30%. It's very similar to that where I'm putting down 30% of my own money and then the brokerage is lending me the additional 70%. So really simply put in this example here, you can see you can almost buy 3 times your cash is a simple way to think of it. But if you take that calculation there and do $5,000 divided by 30%, which is your minimum margin requirement, is what the brokerage will call it, you can see that you could buy up to almost $17,000. So if you see on the screen there, $16,667 would be the maximum amount you could borrow. So you'd be putting down your $5,000 and you could buy up to that amount as taking part of it as a loan. What we do recommend though when you're first starting out with margin and probably even ongoing is not to use all of your available loan value because then you have a risk of you're sort of sitting, living on the edge there of getting into a bad situation, which is called a margin call, which we'll demonstrate later. But if for example in this particular example we're looking at, if you had instead wanted to purchase 200 shares of ABC originally because that's all the cash, all you could afford with your cash, you could now buy 400 shares. You could double that, and you could borrow, for example, $10,000, putting up your own 5,000, and then borrowing the additional 5.
So let's look at some scenarios from this example. What happens if our ABC goes up in price?
No, that's a great question too. I think we have a document to take a look at that as well. This is a good example to go through and something you should really know before you start trading with margin. You want to know the benefits. You want to know those rewards, but you also want to know the risks. So looking at the reward side, so what happens if there's an increase in the stock value in our previous example of $5? So our ABC stock increases by $5. We bought the 400 shares. We ended up creating a debit or a loan, we would call it, a margin loan of $5,000. So that all stays the same. But you can see our actual total cost basis is $10,000. That was our total amount invested. If the stock goes up, we'd be looking at now a market value of approximately 12,000. Okay, we're excluding commissions just for the example here to keep it simple. And then now you can see on that, that's a return on investment of 40% on a stock increase of 20%. So the $5 being 20% of our original 25. So if we had done that with our own cash, we would have gotten, yes, we would have potentially gotten a return on the stock, but now we're actually getting that increased leverage, they call it. Instead of 20% return, we're getting a 40% return on the money that we borrowed.
I feel like this is too good to be true, so I'm going to explore the other way. What if the stock price drops?
That's right, Ryan. There's always the other side, right? The other side of the coin. And in anything in life, or especially in investing, anytime there is risk, there's going to be a reward and vice versa. Anytime there's going to be a big reward, there's definitely usually a lot more risk on the other side. So this actual slide is just demonstrating the exact same thing, but just to make it visual, you can see that our 400 shares, if the stock dropped just by $5 the other way, now we're looking at a scenario where our actual market value has dropped down to $8,000. So instead of going up to 12 like it did in the first example, we bought it at 10, remember originally, and it went down to $8,000. Now we're in a situation where, yeah, that was a 20% decrease in the stock, but it's in terms of a return or a loss, you should say, in this case, it's a 40% loss as well. So it goes both ways.
Okay, so I'm glad we looked at both sides of it there. So we can use that margin to buy stock for a stock buying opportunity. Now, what else can we use margin for?
Well, that's a great question. We can use margin for buying opportunities, as we already talked about, as you just said. But one that a lot of people don't know about or realize with margin is you can actually use it as a short-term borrowing vehicle, or potentially long-term too, depending on your situation. But it is in a way like a line of credit, where if you have fully paid for securities, which many of us do, in our margin account, then you can borrow money from a margin basis. So, to give you a good example, to make it a real life example, is when I was an investment representative, I would get tons of calls. I was on our credit risk margin team, and I would get calls all the time for clients saying, hey, my son, he's going to school next week, and we totally forgot about it, and they didn't send us the paperwork in the mail, and he's got to pay tuition by tomorrow. Is there anything I can do? I've heard you can borrow against your margin account. And to their delight, it was, yeah, absolutely. You have lots of loan value built up in your account. I'll send you the money right now. So it was immediately in their bank account. It was in there that day, or sometimes it would be the next day, and they were able to do a short-term loan against their margin account. So we used to joke too. There was some funny instances where people would call from Vegas and say, "Hey, I'm not doing so well in here in Vegas, and I want to borrow against my margin accounts." That one I definitely wouldn't recommend, but I've seen people try to do that, and you could, but yeah, be careful. Make sure you understand your risks on multiple levels.
Well, it's good to know. Now, I remember a little bit before you had mentioned something about a margin call and to be careful of a margin call. Now, what is a margin call? I want to understand it a little bit better.
Yeah, instead of me describing it just with words, Ryan, let's pull up the example we have here. Just continuing with the same example we have with our ABC stock. So as you can see on this diagram, you have on day one, let's start from the very beginning. We, put money into our account, our $5,000. We ended up on day 5 deciding to buy $10,000 worth of ABC stock. Remember, we only needed to put down 30% of that as a minimum, but we decided to, be a little conservative, and we put down, obviously our equity is going to be that $5,000. That's our own equity. That's what we own. Just like you have equity in your home when you're doing a home equity line of credit or a mortgage, that's your money. Okay? So we borrowed originally, you can see on that day 5, the debit column. You can see that we have a debit of 5,000 because that's what we borrowed. That's our margin loan. And as you go across, if you look at all the different columns, you can see there's your equity, there's your margin rate of 30%. So that's oftentimes a standard rate that we're working with, a standard down payment, you can think of it as. And so we had a loan value of 70%. But if you look at that second last column, the margin required, that's just taking our 30% multiplied by our current market value and giving us $3,000. So 10,000 times 30%. So in the end, on the very far right-hand side, if you see that column that's in green for now, is we have an excess. So we have an additional amount we could borrow on of $2,000. Okay, so keep your eyes going down that list where you can see on day 10, we have ABC is up $5. So that's a situation, remember, different than your home. Your home doesn't fluctuate every day or every minute during the market hours. That's the big difference with margin. This is going to be moving up and down, and it could be potentially giving you more available margin excess, we call it, so more borrowing power, or it could be even giving you less. So on day 10, this has gone in our favor. And if you follow across all of the columns, you can see that our market value increased to 12,000. Our debit stayed the same. Remember, that never changes until the end of the month when you get charged interest. It might be a small amount of interest, but that's going to stay the same. Our equity changed, remember, because we had an increase to our account, and that went up to 7,000. Okay, just on that move of the stock. Keep looking down to day 30, where ABC's now, unfortunately, is down $10. And now we're getting into a situation, focus on the equity. You can see that our equity now dropped by $2,000. So we're saying a $5 drop from our original 25 now results in an equity drop of $2,000. If you look at that far right column, our margin excess or our excess equity is going down, and our available margin buying power is going down as well. Now, what I want you to do is look at the very bottom when you see on day 41, if the stock dropped significantly, or day 40, sorry, and we'll look at day 41 in a second, but if it dropped significantly on day 40, we can see that now with a $15 drop, our equity is down to $980. So it's dropped a lot, and now we have not even enough to cover our minimum required margin, as you can see in that column of $1,800. Okay, so that is exactly what a margin call is. So as soon as we get, I know this is a long example and showing you all the numbers, but I wanted to really make sure everybody appreciates the fact that you're going to have it fluctuate up and down all the time, and you want to know if it does drop down significantly, what could happen. And if a margin call happens, that's a situation where you're now making the brokerage nervous, and they're saying, hey, there's not really a lot left for you to cover this debit. We're going to actually have you deposit some money in here or sell some securities, because we're getting really nervous on the fact that you're not even going to be able to cover the original amount borrowed, and you're going to have to take action on that.
So you mentioned it a little bit. So what do we do, and how do we fix that margin call? You were talking about perhaps liquidating some securities or depositing, correct?
Yeah, that's a great point to make, Ryan, is you do have to take action. And many times in the margin agreement, we do try to stress this very frequently, is the fact that, the brokerage, because they're lending you the money, we are taking all the risk on lending you that money. They may take action without your permission, unfortunately. So that's something you want to make sure you're aware of. We do try to contact you initially, but if the risk is there, we may take action to either sell some of your securities to reduce that loan, or try and get a hold of you as much as possible to say, hey, can you deposit some money, or can you deposit some other stocks or some other things maybe you can transfer from another account, and that's going to build up your equity to the point where you're now not in a margin call. Okay, so there's a calculation that you would normally use for stocks, but it's a dollar for dollar for cash. So as you can see on that screen, there was an $820 call as of that time. You could put in $1,000 and then you're giving yourself a little bit of a buffer, but you're covering that margin call. So if you see down at the bottom, it says you could sell, $3,000 to cover the call. That'd be a little bit kind of going a little bit higher, so giving yourself some wiggle room. So you notice there that now you have much different numbers. You have an account market value of roughly around 3,000. Because remember, we went from $6,000, we sold 3,000. We have a debit of $2,020 because we reduced it by the amount of what we sold. And our equity stayed the same. Our equity didn't change because remember, the portion of that debit that's still left over is there. and we just sold some stocks to reduce the margin loan. So you can see at that point you'd have a little bit of excess, that $80 on the far right hand side.
Okay, I see. So before we get to that margin call, how would I know that I'm getting close to it before it actually happens?
That's an excellent question. And this is one of the most common questions I would get when I was on our credit risk team. If there was somebody that was brand new to margin, they'd be wondering, okay, Bryan, how do I know if I'm going to buy this stock and I'm going to create a loan of this amount? How do I know what my account can drop to before I'm in a call? That was a big concern, and justifiably so, right? You'd want to know that yourself. So you can kind of take action. You could put in a stop order. You could just watch it really carefully. If it's getting anywhere close to that, oftentimes you want to probably take action before then, but you want to have a plan to know, okay, I'm ready to deposit money if the stock gets close to this, or if it gets maybe 10 or 20% close to that point. But let's take a look at this graphic here, and I want to show you a really quick trick that you can do if you are getting into margin and you're creating a simple margin loan by buying your first stock on margin. This is a way you can know where am I going to need to be from a market value standpoint to where I'm potentially going to be in a call. So as you can see, they're using our same example again. If we have day one, we have our 5,000, we have our equity of 5,000, we buy ABC stock. So same example we've been using all the way through. But down at the very bottom, if you can see there, if you know your loan value, so your initial margin requirement or your deposit that was required is 30%. And remember, it's not always a deposit. It just means that if you're going to buy more stock, like we did with ABC, they're going to say now that total $10,000 we have, or that we're actually purchasing, we paid for 5,000 of it. That's our equity. So we're covered because we needed at least 3,000 because of that 30% number, right? So that's what we're looking at here. So if I take the inverse of that, the 70%, and I divide it into my loan or my debit, we call it. So you see at the bottom that $5,000 we borrowed divided by 70%. The end resulting number is going to be what your total market value, so what your complete account value could drop to before you're in a margin call. So if you see that there, that's right on that number at the very bottom is exactly in this scenario where the client could say, okay, at $7,143, I'm going to be at the margin call level, and TDs or whatever brokerage is going to be coming to me and saying, hey, you're going to have to take some action. So I want to watch this and I want to make sure I'm going to do something maybe well before that at, say, if it gets down to 7,500 or 76 or whatever you feel comfortable with.
Yeah, it's good to know that we can kind of prevent that from happening just by keeping an eye out. So we're going to take a moment, everybody, and we're just going to look in WebBroker, some of the terms that you've seen today, what margin trading looks like in WebBroker.
In WebBroker, go to Account Balances. If you hold more than one account, you can identify your margin account by looking for an E or F at the end of the account number. E represents the Canadian component of your margin account, and the F is the US component. This number shows your margin excess. This is the total margin or borrowing room you have. Since the values of your investments change from day to day, this number also changes daily. So it's good to reference it often so you know where you stand. A positive number means you have excess margin that you can use to trade or withdraw funds. A negative number means you're in a margin call, you're in a deficit, and you need to deposit funds or sell some investments immediately to bring your margin into good standing. You can also see your margin balance in an order entry ticket. This number is real time and updates whenever money is moving or a trade is occurring in the account. Changing from the Canadian component to the US component also displays your combined buying power or margin in that currency for easy reference. Since it's real time, this is the best number to use when you're calculating margin. Although a margin account lets you borrow money, you don't have to. If you have enough cash to cover a trade, you can use that. Check here to see your cash balance.
And for those in the live session, we now move on to questions.